Welcome to another episode of Your Money, Your Mission, the podcast where we break down complex financial situations into actionable advice, powered by Johnson Financial Group. I'm your guest host, Dominic Ceci, Chief Investment Officer here at Johnson Financial Group. As we enter a new year, it can often bring a lot of white noise and distractions, making it easy to lose focus on what really matters. Today, we'll discuss why it's a crucial time to review and plan your financial strategy. Joining me are Eric Bernal, Senior Vice President, Wealth Portfolio Manager, and Luke Kasten, Senior Vice President, Private Client Banking. Thanks so much for being here today, Eric and Luke.
Thanks for having us.
Thanks for having us.
All right, let's get into it. Eric, Luke, what are some of the most important things that our listeners should be thinking about as we head into the new year?
Yeah, well, there's a few things that we speak to on a regular basis with our clients, especially if it comes, to November and December. I think even this year, maybe even a bit more important and impactful. I think as an investor and maybe even a client at Johnson Financial Group, taking a look at, the differences and changes of policies going from 2025 to 2026. With the new administration, there's a few moving parts and how it may impact your financial picture. Also taking a look at your portfolio and the current market conditions. A lot has happened this year. A lot of volatility. Seen a nice run up over the last 9 months or so. And the interest rate environment has also changed quite a bit. Lastly, I would say once you get an idea of all these different moving parts, pull out that financial plan. Make sure that all of these moving parts are running in line with what your goals and what you're trying to achieve, within your picture.
Yeah, I think that's well said, right? It's a great time to kind of do a general reset for the next year, right? Kind of review those financial priorities. We have a great document that we utilize with our clients called our Financial Priorities Checklist. And it gets very deep into the weeds, right? And that's that chance to kind of start the new year off fresh, right? And look at the year behind and the year ahead and what's kind of coming, right? And make sure you're prepared from a liquidity standpoint, from a cash flow standpoint. Is this the right time to make some budget adjustments for what you've got coming up in the year ahead versus what you saw in the year in the past, right? And then take a look at your whole financial picture, right, from both sides of the balance sheet. Assets and what you've got going on there with cash, as well as your debt, right? Is it a good time to look at the rate environment, where things are heading, and maybe look at refinancing some debt to kind of increase your cash flow there. So, and another thing too that's I think a lot of people seem to forget about is your insurance, right? Take a look at that, right? We look at what happened this past year. We had some flooding in and around the Milwaukee area, and I would venture a guess to say a good chunk of people had no idea what their coverage was or if they had any for that type of situation, right? So that's something I think is a good chance to do that every year and start fresh.
Yeah, it's an interesting point. There's a lot of flooding, and I know the neighborhood I live in. I mean, basements were destroyed, and I talked to a bunch of my neighbors that did not know what their policy was, and some of them found out bad news, some of them found out good news. It was
unfortunately, a lot of people had to find out the hard way, right? So it's a good chance to look at those things and make sure you're prepared for those unknowns and unexpected events like that.
Yeah, Eric, maybe could you mentioned policy. Are there any specific policies that are on top of mind for you as to what people should be considering for next year?
I think probably one of the more impactful ones, the changes to retirement plan contributions. You think about the limits that you're able to contribute to, like 401ks or IRAs, for example. Just revisiting those and making sure that you are able to, max that amount out and you're familiar with the numbers. Just a couple of quick examples for you. Again, we're taking a look at 401k contributions going into 2026. The limits have increased. They went from $23,500 to $24,500. So we did see a $1,000 increase. Also, the contribution or the catch-up contribution has increased for individuals that are over 50. It went from $7,500 to $8,000. And probably the more unique one is what they're calling the super catch-up for ages or individuals that are, the age of 60 to 63. They can actually provide a catch-up contribution of $11,250 versus the $8,000 catch-up amount. So that one is a little bit more unique as well. And those are some of the things that we want to speak to clients about as they save for retirement, and making sure that they are getting their most bang for their buck and put the most appropriate dollars in the right buckets.
So maybe, Luke, you mentioned a checklist. I mean, what are the right kind of steps that people can start taking immediately, action steps, let's say, to start the new year on the right foot?
Yeah, it's again a great chance to kind of do that reset, right? And I think it's easy to kind of gloss over that, and people are busy, right? They got a lot going on at work, at home, kids, and it's easy to just say, oh, well, we've got our routine, we know what we got going on, and kind of forget it, right? It's a great chance. That hour or two or whatever you need to do to set aside with, either it's yourself and your spouse or whoever it is really critical, right? Because that hour or two that you spend prepping and planning can save you a lot of time and headaches down the road, right? When those unknowns do pop up, right? So be detailed and thorough, right? Sit down and kind of go through your bank statement history, your credit card history, understand what you've got going on, coming in, going out, and really do a thorough analysis of your budget, right? And kind of look forward over the next 3, 6, 12 months. What do you anticipate, right? What's on your outlook for the year? Is it planning for a vacation, planning for a kid's education, retirement, a vacation home, whatever it may be, right? And start taking those necessary steps, and that's where we can really be a great partner and advocate in that, right? To sit down and kind of work through those things with you and kind of help set the right kind of expectations for your future and how you spend your money and where you put it, right? Is it all in the right buckets and where it should be to kind of prepare you for the year ahead, right? So it's a great chance to do that.
Great. Eric, any thoughts on kind of immediate action steps that people should take?
Yeah, definitely. When you think about year end or starting a new year, it is a great chance to look at it from a macro level. Sometimes we get so, bogged down into the weeds throughout the year. And we love doing not only a year-end review of the portfolio, but kind of a year-end snapshot of the financial plan and kind of compare and contrast. If these were the projections a year ago, where do we stand now? Are we ahead of the curve or behind the curve? When you pull that financial plan out at the end of the year, it allows you to do a couple of different things. It allows you to connect the dots. Again, we always talk about the math supporting the story. So what you're able to do is really get an idea, for example, around items like tax planning or gift strategies. I'll give you an example. The market has run up so nicely this year, and there's a decent amount of gains in portfolios. So if someone's looking to, let's say, gift dollars to a charitable organization or a church or a 501, it's a great way to identify and take a look at your portfolio and say, boy, do I have any concentrated positions or any securities that have a very low basis with high gains where I can gift those shares to those organizations rather than simply writing a check. It's also a nice way to do some tax planning. Again, I know that there's not a ton of losses in our portfolios these days, but nonetheless, it's a great way to take a look and say, all right, how many dollars or how many gains have we realized so far this year, and can we harvest any losses to offset those gains to try to come up with a flat tax bill? So again, that tax planning is very important. And then the last piece is rebalancing. The market has run up nicely over the last 7-8 months or so. If someone started the year with a 50-50 allocation, 50% equities, 50% fixed income, they might find themselves a bit more riskier than they were on January 1st if they haven't rebalanced. So it may be a good time to take a look and say, boy, does it make sense to take some of those gains off the table, kind of rebalance the portfolio back to my 50-50 allocation? Doesn't necessarily say you have a crystal ball on what's coming in the future, but the whole idea is buying low and selling high. And right now valuations are pretty high.
So let's just dig into that for a second, because you mentioned the market, you mentioned valuations. We're investment guys, right?
Gotta love that. Gotta love that, Dom.
How can listeners stay informed about the markets without getting overwhelmed, without getting distracted by all the noise that's going on out there?
Yeah, there's some really nice apps that you can download that will give you some very high-level general pieces. Again, you can always, turn on the tube and, again, listen to some of the market channels as well. Many times those will get into the weeds, or sometimes the opinions may be a little skewed. Obviously you can go on some of the larger sites, whether it be Yahoo Finance or something along those lines. I think that you also take a look at the relationships that you may have at the different financial institutions, whether it be like Johnson Financial Group, for example. I know we do a great job in trying to send things out like this today. I know we do a lot of market commentary pieces that we send out also, and we provide simple facts. Again, try not to get too skewed by opinions and whatnot. But there's a range of different channels and resources that you can lean on, and doesn't necessarily you need to be an expert. Sometimes it is just a matter of a 5 or a 7 minute snippet of kind of what's going on. And it just kind of it provides more information for you to make an impactful decision on your finances. But sometimes less is more.
So, Luke, what are some common mistakes that people make when setting financial goals, and maybe how can they avoid those?
The biggest general mistake is not having them at all, right? It's just kind of going through your days and forgetting to take that time to really set those goals, right? And I think sometimes when you set goals, people tend to be very vague and general with them as well. I just want to save money, right? Well, okay, for what, right? Be intentional, be thoughtful about what you're doing, and I think that's really important as you look, because I think it's very. I mean, if we're all honest with ourselves and we look at, how we manage our cash, right, and where that goes. I kind of look at that general 50-30-20, right, concept, right? 50 for your needs, 30 for your wants, and then 20 for your, I call them kind of the what ifs, right? What if we want to go on vacation, to what if something, disastrous strikes, we need a new furnace, whatever it may be, right? And so really looking at that, right, and kind of setting that roadmap for, the next 12 months and what you've got coming. And again, I think if we're all honest, most of us have that wants and needs flipped, right? And looking at, hey, I don't drink coffee, but, hey, every Starbucks trip, right? All those little things add up. So be detailed and thorough, get into the weeds on that, and really kind of go through it with a fine-tooth comb to make sure, hey, am I being smart and resourceful with my money, right? And then as you put that cash, management strategy in place, and look at the next 3, 6, 12 months and what you've got coming. If you've got excess cash, right, should it be sitting in your bank account with me? Probably not, right? That's when we should involve someone like Eric, right, on the investment side to look at more longer-term strategies for those excess funds, right? So be intentional, be smart, and be thorough with what you've got going on.
So you mentioned cash quite a bit in that response. That's an area where people, you can run into issues, right? Mm-hmm. You might have appreciated assets, whether they're market assets or something else. You bought a house, and you own property that's worth something, but you don't have cash, or you don't have the cash that you need to do with something. I mean, how do you plan for that, and what can you really do about it?
Yeah, and that's where, again, that financial planning conversation that we have with our clients, right, that's kind of a general expectation that we set in our meetings with our clients, is you should expect we're going to have that conversation with you, right, and look through that component of your financial well-being. And so, yeah, you may not have excess cash sitting on the sidelines, but how do you prepare yourself for the year ahead, the unknowns, right? As we kind of talk about minimizing the uncontrollables in your life, right, and making sure you're prepared for all of that. One thing I want the majority of my clients to have is have an emergency line of credit set up, right? Whether it's against your home as an asset that you've got some equity in, or another great strategy to take part in is if you've got an investment portfolio, non-retirement assets, but a general stock bond mutual fund portfolio that we're managing for you here at Johnson Financial Group, we can put a line of credit in place against that, where we can leverage those assets, right? Because if you get in that situation, now all of a sudden, X happened, we need some cash, right? Well, if the market is doing what it's been doing, right, and now you've got potential taxable, right, consequence for pulling money from the market, we can avoid that by leveraging those assets. If you're running up at 7, 8, 9, 10%, and we can leverage that at 5, 6% on a line of credit, right? That's there for you to give you that peace of mind in the back of your head, right? And it's a no-cost thing to implement and have sitting for you to give you that, hey, I can sleep at night knowing we're covered if something happens, right?
So both of those examples that you gave, I mean, those are situations where you can kind of do the work ahead of time, mm-hmm. have the facilities in place, and it doesn't really cost you anything unless you actually draw down on that
correct
loan facility, right?
Yeah, on a portfolio line, you don't pay unless you use it, right? Yeah. Whatever you draw on it. And I can't tell you in my 20 years the times I've had clients come to me and say, I need X for this, right? Well, when do you need it? Yesterday, right? Because something came up and something happened, and now we're unprepared. Now we've got to go through and rush and try and get something in place. put it in place. It's there when you need it, and it gives you that peace of mind to know if those things do come up, we're covered. So it's a great and if you don't have one, I would highly recommend talking with your advisor or your relationship manager to say, hey, I heard about this. Tell me more, right? How can we do something like that to make sure we've got something like that in place to, kind of keep us in a good place of peace of mind.
Yeah. If I can compliment that, I mean, as a portfolio manager, and you see a lot of our clients have not only your traditional stocks, bonds, cash, but many of our portfolios also have alternative investments within them. And alternative investments, as they've been able to provide some premium returns, sometimes alternative investments aren't as liquid maybe as we want them to be, dealing with private credit, private equity, private real estate, and whatnot. So we're always recommending clients and certainly complementing our portfolio with the bank side of the business, making sure that, hey, let's put a line of credit against the assets. Worst case scenario, if you find that second home that you love that you need to purchase it immediately, or again, if you've seen you want a car, you wanted to buy a car, you needed a new roof, and you needed immediate liquidity, certainly something you can get to right away and wouldn't have to stress the portfolio too much.
Okay, so I feel like we've covered a lot here. I think, are there any final tips or anything that you want to kind of tie it all together with at the end here to make sure that listeners kind of catch that most important thing?
Yeah, well, I think that you can see that we're clearly, hitting all cylinders on the financial plan. The financial plan tends to be a roadmap. It helps you make decisions so you don't have to time, or you don't have to, try to time certain situations, whether it be the market or whether it be certain tax situations. It really is just going to provide a guide for you. So I think that that's probably the biggest piece to get out of this conversation. Another item that I will say that we're having conversations with clients around is just around, retirement planning in general. Okay. So you're seeing the baby boomers getting, either in retirement or on the verge of retirement. And what we're seeing is that, the baby boomers of the world, they've stuffed so many dollars into their 401k plans and their retirement plans that when we're running these financial plans and they're turning 73, 75 years old, their required minimum distributions are enormous. And many times those are their highest income earning years, just based off of the amount of money that they have in these 401k plans. So for a lot of our individuals that are retiring and we're taking a look at what their tax situation looks like, there may be some very unique opportunities for Roth conversions and pulling some of those dollars out of those 401ks tax-deferred vehicles at lower tax rates now, but saving them dollars and keeping their tax rates lower in the future. And I know sometimes it's a hard concept because we all don't like to pay taxes at any time. And if we didn't do Roth conversions, we'd be in a lower tax bracket, when we retire, and we would enjoy paying lower taxes. But when you look at the plan and you look out in the future and you see that enormous amount that's going to need to be taken out of that 401k plan, it really starts to open eyes. So again, that financial plan does so many things. Not only helps you be financially fit today, but also provides a high level of efficiency in your later years.
Financial planning is so critical to just your whole financial journey, right? I want to maybe zoom out just for a second. Can you tell us just a little bit, what is that experience actually like? How much work does the client have to do? Who do they work with? Who delivers a plan? Do you just kind of say, here's your plan, and then you walk away, like, here's a packet of stuff, and, have a nice day? What does that look like?
It's a good question. I mean, there's some heavy lifting done, in the earlier parts, right? Because sometimes we have our head down and we're just working, day to day, and, we're really not tracking all of the different moving parts within our finances. So we do need to kind of wrap our arms around all of the ins and the outs and some of that hard data. But then also it is a matter of kind of looking in the mirror and really what we're trying to accomplish. We talk about, the purpose behind the money. And I think that that's also a hard piece for clients that, they haven't thought a lot about, who do I want to impact? What type of lives do I want to impact? What type of communities do I want to impact? Obviously, first and foremost, we need to make sure that we're self-sufficient in retirement, and we need to make sure we're taking care of ourselves. But, once we can kind of stick the flag in the ground and declare victory that retirement's going to be okay, what else now? And then once we have all of this data and information, all this knowledge, then it's, again, work on our part to start constructing that plan and start to mold it and customize it. And this is a living, breathing entity. It's never something you just put on the shelf and forget about. For individuals that work with us, we tend to have 2 meetings a year. One meeting is very portfolio driven, speak about returns, how are we doing versus benchmarks, things along those lines. And the other meeting is more planning. Okay, we said we were going to do this a year ago. This is what's come to fruition. Again, are we ahead of the curve? Are we behind the curve? What changes have happened? Has our probability of success gone up or down? So it's a very detailed conversation, and that plan is always going to evolve. I mean, you being a father, sometimes we don't even know what we're doing next weekend, let alone 5-10 years from now. So again, that plan should always reflect where you're at in your current situation.
Great. And if a client has a plan, but maybe hasn't updated it in a while, how often do they need to look at that to make sure it's right?
We like to do it annually, but I would say at minimum, you probably want to do it every other year. And I think also it has to do with where you're at in your life stage and the probability of success. So we do have some clients, and there are individuals that are out there where maybe the plan is a little tighter and they got to keep a close eye on it. Maybe spending needs to be watched a bit closer. And some where, again, they're living well within their means, and, they're not worried about, having enough for retirement. It's more of, some of those wants versus the needs and what they're trying to accomplish there. So I think that's where you have to ask yourself, how close do I have to stay to this? But I would say in an ideal world, annually, at minimum every other.
Okay. So action step right there. If you don't have a plan, get one. If you got a plan, but it's maybe a couple of years old, let's update it.
Right. We haven't even spoken about estate planning and how that impacts that as well. So again, when you think about financial planning, it's all encompassing: tax planning, gift strategies, portfolio efficiency, estate planning. It's just going to wrap your arms around your financial picture and just provide that high level guidance that's needed.
Great. Excellent. Luke, kind of same question, as you think about the topics we've covered here today, we've covered quite a few things, but we could probably talk for hours and hours. Is there a, one big takeaway or one big action thing or something that you really want to drive home to listeners?
Yeah, I think Eric covered a lot of great things, but on my end of things, right, on the banking side, right, it's being intentional, be thorough, and detailed with what you do, right? It's much like the plan, right, and I wholeheartedly agree, right? That plan is a living, breathing document, right? That you're continuously, it's continuously evolving with you in your life, right? And so much like on the, cash flow side, right? That's the ebbs and flows of that are continuous, right? You look at, I think right now through just our lives with kids and activities and winter and, all the things coming up, right? There's a never ending stream of things going on in our lives, right? And so be intentional, be thorough, be detailed with what you do, right? And have a real understanding, right? I think Eric said it before. Be willing to look in the mirror, right? And really say, is that our want or a need, right? And could I be better preparing ourselves for those what ifs? I think that's something, not just the listeners, right? I'm guessing the three of us could probably always be better about that too, right? So it's a conversation that my wife and I have, every year, and with the ages of our kids, right, younger, it's probably a quarterly conversation that we're having throughout the course of the year. So, be intentional and do your best to kind of, like we said, minimize those uncontrollables and the unknowns, so you've got that peace of mind, and you can just focus on the things that are really important: your family, your work, and your kids. And on the other side of that, I think as we look at, I think one thing that's very easy to do, and one of the beautiful things of the financial plan is it's all encompassing, right? We're collecting. It is a lot of work up front, right? You collect a lot of data to kind of put together that whole puzzle, right, of your financial picture. And as you do that, I think it's very easy. You hear a lot of things talking about, asset allocation, risk tolerance, and as you focus on your true assets, right, that side of the balance sheet, don't forget about the other side of the balance sheet, right, your debt, right, and there's good debt and there's bad debt, right, and that's the conversations that I want to have with my clients of, hey, as we talk through the things that you want to accomplish in your financial life, right, maybe the best path is to liquidate from the portfolio. But there are other options. There are other solutions that you may not be aware of. And let's have those conversations and say, hey, we're in an environment right now where we're seeing, lending rates start to drop down a little bit, right? Do you have old debt out there that, obviously we went through a period in the early 2000s where mortgage rates were, historically low, right? But people have moved on. Life has changed and people have to move. And one example, I have a client who she bought a car, I don't know, in the last year, and it was not a very favorable rate. And we were having our annual financial plan discussion, and she brought that up, and we looked at it and we said, well, that doesn't make sense, right? We talked about the portfolio line. We actually swapped the debt over the portfolio line. She's paying 1.5% less, paying her same amount every month, but less interest, more goes towards principal. She'll have it paid off faster, right? So just those types of conversations, and be thoughtful about both sides of the balance sheet, and focus on what you can control, and kind of, I don't know, like we talked about, if you have a plan or don't have a plan, let us be your champion as we try and kind of get you to that place of peace of mind in your financial future, and have that discussion.
Great. These are all great tips that our listeners hopefully will take away and take some action on. So I want to thank you, Eric and Luke, for sharing your expertise. And to our listeners, remember, a well thought out financial plan is the key to a successful new year. So thank you all for tuning in. If you have any questions you'd like us to tackle, please go to the show notes, type your question, and hit submit. Also, don't forget to subscribe so you don't miss out on any future episodes of Your Money, Your Mission, the podcast designed to turn complex financial situations into actionable advice, powered by Johnson Financial Group.
This podcast is not a recommendation to buy or sell any investment or financial products. Whether a particular investment or financial solution is right for you depends on the facts of your particular situation. Please consult your own professional advisors prior to taking any action based on the content of this podcast. Wealth management services are provided through Johnson Bank and Johnson Wealth Incorporated, Johnson Financial Group companies. Additional information about Johnson Wealth Incorporated, a registered investment advisor, and its investment advisor representatives is available at advisorinfo.sec.net. Investment products are not insured by FDIC, are not deposits, and may lose value.
Bank services are provided by Johnson Bank, member FDIC, equal housing lender. Bank services are provided without regard to race, color, national origin, sex, handicap, or familial status.